Every year, millions of American seniors reach a crossroads with their life insurance policies. Perhaps the original reason for purchasing coverage, such as protecting growing children, securing a mortgage, or mitigating estate tax liabilities, no longer exists. Alternatively, you may be facing unexpected, steep cost of insurance increases on a universal life policy that threaten to consume your retirement savings. According to industry data, nearly $750 billion in life insurance face value is surrendered back to carriers or allowed to lapse annually. In fact, roughly 90% of all permanent life insurance policies terminate without ever paying out a death benefit. When seniors decide they can no longer maintain a policy, they typically assume there is only one exit strategy: surrendering it back to the insurance carrier for whatever cash value remains. However, your policy is a piece of personal property, and just like real estate, its true market value in the secondary market can far exceed what the issuing insurance company offers. Today, we examine 3 distinct options for exiting an active policy and compare the actual financial results of each. Option 1 is surrendering your contract directly to the issuing insurance company. When you surrender a policy, the insurance carrier calculates your payout using a rigid internal contract formula, the total cash value accumulated minus any loan against the policy. The insurance carrier has no economic incentive to pay you fair market value. In fact, insurance companies rely heavily on policy lapses and surrenders to eliminate future death benefit liabilities while retaining years of paid premiums. Data from the Life Insurance Settlement Association highlights the reality of this option. The average cash surrender value offered by life insurance carriers in 2025 was $24,360 per policy. When you choose option 1, you walk away with the absolute minimum payout set by the company that issued the policy. Option 2 is responding to a direct-to-consumer advertisement, such as those frequently broadcast on television or online, and selling directly to a life settlement company that acts as or represents a single institutional buyer. While these companies offer an immediate alternative to policy surrender, it is critical to understand who they represent. A direct buyer or provider representative acts as a buyer's agent, not yours. Their mandate is to acquire life insurance assets for institutional investors at the lowest possible price to maximize their own investment returns. When you accept a direct cash offer from a single buyer without market competition, you receive one offer in a vacuum. Because you have no market evidence of competing bids, you are left in the dark about whether that offer reflects true fair market value. While direct buyers often offer 2 to 3 times the cash surrender value, making it appear attractive on the surface, it routinely represents a fraction of what the policy is worth on the open market. Option 3 utilizes a licensed, independent life settlement brokerage firm that acts as a fiduciary to you, the policy owner. Unlike direct buyers, a fiduciary broker represents your interests exclusively. Under legal and regulatory guidelines, a broker's sole mandate is to obtain the highest possible purchase price for your policy. They accomplish this by placing your policy onto a centralized, competitive auction platform where 15 to 20 or more licensed institutional buyers actively bid against one another. Just like a bidding war in real estate, forcing institutional investors to openly compete drives the purchase price up toward true fair market value. Industry-wide market data published by LISA in 2025 revealed that policyholders who sold their policies through a licensed broker on the secondary market received an average payout of $212,066, nearly 9 times the average cash surrender value offered by insurance carriers. To understand how these 3 options operate in practice, let's examine documented case studies from the nationally recognized independent life settlement firm we work with. The story of June, age 84. June owned an unneeded life insurance policy with a cash surrender value of just $25,000. Seeing a television commercial, she called a direct buyer and received an immediate offer of $75,000, 3 times her surrender value. Before accepting, June brought her policy to our independent fiduciary broker, who submitted it to a competitive policy auction. The auction generated 14 separate bids, driving the final winning payout to $475,000, 19 times her cash surrender value. In a dramatic illustration of market competition, the winning bid came from the very same institutional buyer that had initially offered her only $75,000 directly. Herb and Toby, ages 77 and 76. They owned a $500,000 universal life survivorship policy with mounting premium obligations and a cash surrender value of only $12,000. Through a competitive policy auction with 14 institutional bidders, they secured a final cash settlement of $95,000. Carlos, age 87. Carlos held a $5 million universal life policy facing high ongoing maintenance costs. The policy had a net cash surrender value of $386,000. After 24 bids, the competitive auction process yielded $1,650,000 in cash. Mike and Sharon, ages 78 and 77. They held a $2,500,000 survivorship universal life policy with a negligible cash surrender value of $26,000. The open market auction resulted in a cash payout of $612,000 after 17 bids. Navigating the secondary market for life insurance requires unbiased expertise and total alignment with your financial interests. Hidden Asset Advisory Group was formed to bring this transparency directly to policy owners. Hidden Asset Advisory Group represents a strategic collaboration combining over 50 years of dedicated life insurance expertise with a premier 23-year-old independent life settlement firm. Hidden Asset Advisory Group does not buy policies, sell life insurance, or manage assets. Our single role is to act as your advocate on the secondary market, using a proprietary valuation model and competitive bidding auction among top institutional buyers to ensure you extract maximum value from your policy. While a life settlement can unlock substantial liquidity to fund long-term care, eliminate debt, or enhance retirement reserves, it is a significant financial transaction. Before initiating a life settlement or surrendering a policy, we strongly recommend that you consult with a qualified financial advisor, CPA, or estate planning attorney. A professional evaluation will ensure that liquidating your life insurance policy aligns with your broader estate plan, tax considerations, and personal financial goals. Thank you for watching. If you have a life insurance policy that you are considering surrendering, you can find more information about how to determine if your policy may qualify for a life settlement below. And if you found this video helpful, you may want to watch our video, What is a Life Settlement?, which goes into more detail about the mechanics of a life settlement. Just click the video thumbnail above.